Hey guys, it's Eddie here again. Today we're doing a quick video and we're talking about retirement accommodation, yes or no. This video is all about a question that was asked to me, that someone reached out to me actually on LinkedIn not too long ago, and they asked me the question, would you invest in retirement or over 55 villages complexes because they have a really amazing rental yields, they have really amazing cash flow. And so I thought I'd do a quick video just explaining the ins and outs, my thoughts on investing in retirement accommodation. Sometimes you see them online as retirement villages, over 55 accommodation and that kind of thing on realestate.com and Domain. I've never bought any of these, just putting it out there. I've grown my portfolio to 14 properties by the time I was 26 by investing in normal properties that mums and dads and families can buy, properties like houses, townhouses, units within metro areas with good rental yield and growth potential, and you want to pick it up below market value as well in a metro area. Retirement accommodation, just explaining a little bit about what that is. You might find when you do start jumping on realestate.com and Domain and searching around your local areas and different suburbs that you might see something on there and think, oh, that's amazing value, it's really cheap, it's got a good rental return. It will actually be retirement accommodation or over 55 villages. One of the factors is to why we don't buy this kind of stuff is due to risk. I basically deem it as much higher risk as opposed to just buying a normal, say, house or a townhouse or a unit that an investor can buy or someone can actually buy to live in. With retirement and over 55 accommodation of that sort, how I see it as high risk, because basically if I buy a property and I want to then sell the property really quickly, or for whatever reason I might need to offload it really quickly, the people that can buy, and I'll put risk on the board as being number one. So that's point one, risk. Say you need to sell this property really quickly and it's over 55 accommodation. These can sometimes be, for example, $100,000, cost $100,000. Sometimes they rent out for $250 a week, which is an amazing return. It could be $200,000, $300,000, $400,000, but often they have a really good rental return of 10%, 11%, 12%. So they're really good cash flow. So sometimes people do get, suckered into buying these kind of things, and not saying you can't make money from it, but it's just a lot. There's totally different strategies to what I've adopted and how I've grown my portfolio. Going back to risk, so say you need to sell the property really quickly. The type of people that can buy these kind of properties, 90% of the time are only investors, because very rarely someone that age over 55 or whatever it is going to buy one of these. They might buy it outright after retirement or whatever it is, but most of the time they just appeal to investors only. So if it came a time where you had to sell this property urgently, the amount of people, say you ever need to sell this property, the amount of people that can buy it automatically gets cut in half, because pretty much only investors can buy these kind of properties. So say for example, when you're buying a normal house, townhouse or unit, you could sell property within a couple of weeks, a month, 2 months, 3 months. Some of these retirement complexes, over 55 villages, they take sometimes 6 months, a year, sometimes even more to sell. So in terms of offloading that really quickly, it's a lot harder to actually get rid of it. And as well as, they don't always follow the same growth patterns as, regular properties out there in the market, because so many people can buy these kind of properties. So risk is one. Number two would be finance. Excuse the messy writing. Finance is another risk, is another factor to buying retirement villages and over 55 accommodation. Sometimes it's very hard to get finance. Say for example, they are $100,000 or $200,000 for these kind of purchases. Often banks don't actually lend because they deem it as commercial lending, because it's not actual proper house, like a residential lot. It's within a community, and sometimes it's deemed as a business. So with finance, it's just, you might have to do a 20%. If you can get finance, depending on what lender you go to, you might have to do a 20% or a 30% deposit, which can really, add up. And I guess the main reason why someone would be buying it is because it's a low entry price. But when you have to do 20, 30, 40% deposits, it kind of, negates the fact of putting less money into it because you have to put more deposit into it, and you could have bought something bigger like a house or a proper residential property. So finance can just be a big pain, and with me and how I've grown my portfolio is dealing with the standard foundation type properties that you can get finance, you can refinance whenever you want, provided you can service. Release equity, buy another one, release equity, buy another one, save more, buy another one, and just continue accumulating. So in terms of getting easy finance on these kind of properties, it is a lot harder. I could dive into a lot more information, but we'll be here all day. So that's point 1. 2, number 3, I guess, would definitely be management fees and all the different associated costs with these kind of things. Often with retirement complexes, the management fees, they can be $100 a week, $200 a week. So yes, you might buy something for $100,000, $200,000, whether it's Brisbane, Sydney, Adelaide, Melbourne, and it's a retirement complex, and you pick it up really, really cheap, and say it's even $200,000, and it rents out for $400 a week. So it's a 10% yield, and everyone's jumping around like it's crazy, and it's really good. Out of that, you could pay $100, $150 management fees for the actual, because usually they have on-site carers and all that kind of stuff. So it depends all around, but yeah, the fees can just be astronomical. So I want to buy a property that will grow in value, I can increase the rent, I can buy it below market value. Buying these ones, comparable sales can always change. So it's very, very difficult in that sense, and it's a totally different ball game as opposed to buying normal residential property that anyone can buy. If you buy a proper residential house, townhouse, or unit, an investor can buy that. A family that's going to live in it can buy it. Whereas these kind of things, mainly just investors can buy it. So it kind of cuts your market in half, and it gives you a bit more risk in that sense. I'm sure you could make money from it, like people have made money from it, but in terms of my understanding of building a portfolio, creating wealth, it doesn't tick the boxes for me at this stage. So retirement accommodation, yes or no? I'm gonna have to go with no, and that's the one that I choose in this scenario for retirement accommodation. So thanks for watching, guys, and I'll catch you in the next video. Bye.